Everybody, this is Phil Holoka from Complete Captive Management Services. Today we come to you talking about the very exciting captive accounting. So it's been a while since we've talked, so let's jump right in, shall we? To talk about the financial statements of a captive insurance company, you have to address the profit and loss, commonly known as the P&L, as well as the balance sheet. So in this example, let's talk about the employer, who is the insured, has a premium of $100,000. So in this example, the employer has top line revenue of $1 million. And then they have other various expenses of $700,000, and there's the premium expense, $100,000. So you add those two numbers up, you get $200,000 of profit. Now, within the United States, if you're a C corporation, your income tax rate is 21%. So you multiply 21% with 200,000, you get a net profit of $158,000. Okay? So let's pause for a second. In the captive world, we know that there are only two types of captives. There's a reinsurance captive or a direct writer captive. If you're a reinsurance captive, that means there's a fronting carrier involved. So in this example, the employer is paying $100,000 of premium. That premium is going to the fronting carrier, expressed right there. The fronting carrier then has a fronting fee or an administrative expense that is taken out there. And then your fronting carrier may also charge a quota share or some percentage of the premium, which would be expressed there. Now let's assume for a second these two fees total $40,000. You back out those fees, you're left with 60 grand. Now what's important to walk away from is these fees are memorialized on the bordereau report. This is the expense load. You need to get your hands on the bordereau report to get an understanding of what the expense load is. So you have $60,000 of net premium. Let's assume for a second you have $30,000 of claims. There you go. You have $30,000 worth of profit within this structure. Now, if you're a direct writer captive, which means you don't have a fronting carrier, the $100,000 you're expensing up here lands in your captive. Left pocket, right pocket. SG&A expenses. Sales, general, and administrative expenses. Let's just assume that it's the same as above, and that is a $40,000 SG&A expense, leaving you with $60,000 of net premium, which effectively is cash to pay claims. And let's also assume in this example that you have a claim obligation, which is $30,000. Okay. So on the balance sheet, this is where everything flows down into. For the employer, the insured, let's assume that they have $1 million of cash. That's an asset. And of this million, $158,000 is part of that $1 million. And let's say the insured has about $5 million of property, plant, and equipment. The building, the equipment that makes the widgets and so forth. That's $5 million totaling $6 million. Then liabilities. Every balance sheet has assets, liabilities, and equity. Let's assume that there's a loan outstanding and you have accounts payable of $100,000, leaving $500,000 of liability. Very simple math. Your retained earnings or your equity is $5,500,000. The simple delta between this and that, $5.5 million. On the captive side, you've got $130,000 of cash. Now wait a minute. 30,000 rolls into this number, but where's the 100,000 coming from? Well, every captive has to have some level of surplus. Sometimes it's called capital. So what we didn't mention is this captive has a $100,000 capitalization requirement. That's expressed in cash and it's balanced in equity on your balance sheet. So sometimes this is called additional paid in capital or surplus, but it's going to be reflected down here on your balance sheet in the equity section. The other new item in the captive insurance company is incurred but not reported. That's an unknown liability or an estimate that the actuary provides you, and it simply means we don't know what type of liability is still out there. Therefore, we're going to estimate something, and we're estimating it to be $20,000. So when you back out the 130, you back out the 20, the retained earnings is effectively your profit in the captive, and that's $10,000. Okay? Hope this was helpful. Just a quick overview of the P&L and the balance sheet as it compares and contrasts between the two entities. Next week, we're going to talk about what's the difference between collateral and capital. Talk to you next week. Bye now.